Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog slash newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu. And these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you. Hey guys, welcome back to Be Rich. Today we're going to be talking about ETFs, or otherwise known as exchange traded funds. They are dominant in the US and generally encompass most asset classes which one would like to purchase. And it happens to be one of the easiest ways for investors to get their hands on certain asset classes, especially ones which aren't openly traded on the market. Otherwise, those asset classes are covered by ETFs. Pretty much anything you can imagine is probably covered by an ETF in America. Some person has thought about it or thought of it, and they've issued an exchange traded fund for it. And this can be even art, it can be real estate, it can be your stock market, which is your S&P 500, gold, bonds, you name it, they have it. That's an exchange traded fund. So how do exchange traded funds work first? So exchange traded funds are nothing but basket of assets. These assets can be any of the assets I had mentioned before or something other than that. So the point is, these baskets buy a certain amount of assets and put it in the basket, and then they sell you rights to own percentages of that basket. So it's almost like a mutual fund, except for the fact that this is something which purports to be different because the costs are typically lower on an exchange traded fund than a mutual fund. And the way mutual funds and exchange traded funds are legally recognized are different. So exchange traded funds tend to be treated as an asset class rather than a fund per se. It's treated as something which can be traded on the market, hence the name exchange traded funds. So how does a passive exchange ETF work, exchange traded fund work? So the underlying assets in an exchange traded fund is the S&P 500 in that case. So they take whatever money they get and they purchase the index with it. And yes, of course, there'll be some maintenance costs and some operational costs, but these are typically very low. And you can expect your expense ratio to be quite low when you buy an exchange traded fund. And this exchange traded fund can be bought and sold very easily on the market. So it's almost like buying a portion of the S&P 500 any day you want and selling it any day you want. So with a mutual fund, you don't get this luxury. It takes some time to get into it, get out of it. They have to disperse your money. It's a long and complicated process with a mutual fund. But with an exchange traded fund, it's as simple as hitting a sell button or hitting a buy button on it. So this is the advantage which ETFs bring. So there's this investor and mutual fund manager as well as fund house owner named John Bogle. He is the father of passive investing. He is the founder of the Vanguard Group, one of the largest money management groups in the US. And they're the largest index funds in America because, of course, he's the father of passive investing. And he actually was kind of skeptical of ETFs. He said that the point of passive investing is to bring down minute by minute trading, because he said that minute by minute trading is what causes most investors to give away their gains in the market. He believed that if you could resist the urge to trade every second, you would be making and raking in a lot of money from the market. And he thought that ETFs, because it made it so easy to buy and sell, he thought that this was a wolf in sheep's clothing. It was meant to be an investment vehicle which money managers, or rather people in Wall Street, were trying to package as a passive investing tool to basically shear the sheep. Or in this case, it's to take
money of the investors
through expenses. And of course, the saying goes, or rather not the saying, but the truth is the fact that whether you make or lose money, the people in Wall Street are going to make money off of you. Which
the house always wins.
The house always wins. And it's said in this book as well, where he says that regardless of whether the market went up or went down, when the trading bell rings at the end of the day in the NYSE, that is a New York Stock Exchange, most people rejoice. So This is the point which John Bogle was trying to make. But so many years after his passing, and the fact that today we are in 2024, let's actually examine and see whether ETFs have been as bad as Jack Bogle had talked about ETFs and his skepticism towards it in the 90s. And today we're in 2024, which is almost 34 years after when he talked about it. And for the most part, ETFs have been something which have helped people get into passive investing. A lot of people who wanted to passive invest today, most of them go for ETFs because of the ease in which they're able to buy ETFs and get out of it when they need to get out of it. The liquidity which it gives people is something which they like a lot. So most people are happy to hold ETFs. But there is a key development in ETFs over the past few years, especially after 2021 when a lot of money was released into the market by the Federal Reserve. So the interesting thing is today we have ETFs which own anything and everything. So there's all sorts of asset classes which most investors usually wouldn't get their hands on. Let's say during Graham's time, people like us, that is small retail investors, wouldn't have a chance to get sucked into, let's say, the art market or get sucked into any sort of complicated asset class which they didn't understand. You either had options to buy gold, you could buy some stock. Even stock was considered a rare asset form to hold for most people back then. And you could own some bonds. These were the ways or real estate, of course. So these were the ways in which people could hold money back then. But today, ETFs have opened up a large pool of resources for small time investors like us to pick and choose. And yes, some of you may view this as a welcome development, but I would view this more cautiously because most investors do not have the caliber, like it or not, to analyze assets with that level of complexity. And this is even into institutional investors, even investors who are very, very robust in their knowledge. Even they struggle with these ETFs. So I highlighted that ETFs have a different regulatory structure than normal mutual funds. So mutual funds are required to be transparent, where they have to disclose their holdings every day. But there have been new ETFs which have been permitted by American regulators since 2019, which are called semi-transparent, where they only have to disclose it once a quarter. But the problem is, like with mutual funds, there are other regulations which are in place where they can hold a certain group of assets and they can't deceive the investors in a certain way. These semi-transparent vehicles, ETFs, are allowed to invest in whatever they want. And they are only required to disclose their holdings in every quarter. This basically means that you're giving them free rein to do whatever they want. And pricing these ETFs are going to be difficult. So this is one of the drawbacks with what the ETF market has brought forth in terms of innovation. And a lot of illiquid assets are being bundled into ETFs and being sold. This may be a welcome development because you have exposure to certain asset classes which you wouldn't have before. But the problem here, if there is a run in the market, then these illiquid asset classes are going to be the first asset classes out of which money is sucked out of, which means that you may end up holding the short end of the stick by the time such a bear market comes into place. And finally, there are these ETFs known as defined outcome funds, which are basically ETFs which say that I'm going to give you protection against falling prices, but you have to forego any returns you make of above 10% every year. This may sound great in theory, but it's not, because most of the compounding effect of stock ownership comes from rallies. We discussed this in yesterday's video or day before yesterday's video, where we talked about gold and why you may want to own it for the long run. And we talked about stock market doing very good in the long run, better than gold even, and how they make more money during bull runs and lose some during the bear market, but then it's a bias towards the bull run. So similarly, if you look at the fraction of in the past 27 years, if you look at how much the S&P 500 has been able to yield, if you had just held it for that period without selling and just buying and holding, you would have made 3,155% on your S&P 500 holding. But if you held a defined outcome fund, you would have only made 403%, which is a small fraction of the 3,155%. So for most of us, it does not make sense getting into that kind of asset class. So these are some of the drawbacks. So where do you think we stand on this ETF business in America?
I don't know about America, but in India, what I understand from mutual funds and ETFs are simple. Then I'll talk about what I've understood in the US. In India, ETFs are still very nascent, meaning they're very new. Most ETFs in India are passively managed, though you can have active funds. There are no actively managed ETFs in India. The passive ETFs in India are trading the Nifty 50 and Sensex. And the main difference, as an investor would ask, is instead of putting in mutual funds, what is the advantage of putting in ETF? Yes, cost difference, because they're both passively managed. There's no active manager in it. So the cost is very negligible between both of them if you really look at it. But the main reason mutual fund and ETF, as an investor, you need to look at it is the ease of liquidity in it. ETF is in India traded in the open market time. That means during the market hours, you can buy and sell those ETFs as you wish. There's no problem. Mutual funds do not work in that way. They are only allowed to sell and buy your mutual fund units after market hours. So after the market is closed, there are a few hours during which mutual funds are traded after market hours, which I would say is the main difference. Other than structurally speaking, both are the same concepts. Money is pooled in from investors, and using that pool, they invest in an asset class like you said. Mutual funds are very exotic in India, but ETFs have not reached that level of complication in India. Meaning, I cannot say buy 5 properties and make that into an ETF and say you own pieces of this property. In US, you can do that.
There are REITs in India. The first one is Happy Mind, I think.
Yeah, REITs in the sense that that's a rental income, meaning owning the property and getting rental income.
Yeah.
But you can make the ETF very exotic, like you said. You have a bunch of paintings.
Yeah.
You can value, a statue.
Yes.
And all of us make that into an ETF. And all of us own a piece of that statue.
Yeah.
It's like your NFTs. NFT is, of course, in a virtual world. ETFs is in the physical real world. You cannot have intangible asset as an ETF. You cannot say you can own a bit of my emotions.
Yeah.
My happiness I'm selling as an ETF. You cannot do that.
Yeah.
It has to be something physical and tangible. So ETFs are in that segment. And of course, as an investor, it is open to gambling. What Jack or John Bogle said, the temptation to gamble creeps in. But of course, this is also true in stocks. The same problem stock market and stocks have because of trading and, futures and options, that also plays into the ETF realm. So end of the day, it depends on you. If you have control, self-control, and you're able to forego gratification, then ETF is not a problem. But you get tempted into buying and selling and flipping because you're seeing your ETF going up and down and it's giving you anxiety, then ETFs is not what you should be doing. And even stock market is not what you should be doing. You're better off sipping in a mutual fund, passive fund, and forgetting about it because you don't track the market. No one actively sits and tracks their mutual fund NAVs every day.
So before we close off the video, there are some funny ETF ideas which are actually in the US market, which
you can buy.
So there's one called "What Would Jesus Do?" Whose stock ticker symbol is WWJD, which is short for "What Would Jesus Do?" And it believes in investing companies which are aligned with biblical values. Invest in companies that are blessings to their communities and adhere to the faith. There's one called the Vice ETF, which only invests in...
Yeah, I'm sure there's Green ETF, which is only carbon neutral.
Yeah.
There are other ETFs which does not go against, companies which are not invested in racial segregation or whatever. You can, anything which is your fancy. But the trick here is, the guy who's really smart is the guy who sets up the ETF.
Yeah.
Because he sees a market potential for an ETF and he concocts his ETF and he floats it. And people immediately jump behind the queue and they jump on the bandwagon. So it's like a snake oil charm guy coming into the town. He sees what this town is lacking. He's got the same ingredients.
Yeah.
The problem is he's got the same snake oils. So when he walks into town, he'll see what is the major ailment in this town. Most people are coughing. Today he's got cough medicine. He'll go to the next town. Most people are having back pain. All the same oils will be curing back pain.
Yeah.
So that's what happens with ETFs.
So that being said, the same tool can be used for good and bad. So the choice is up to us on how we decide to examine what we invest in.
Correct.
That being said, you can probably never go wrong with indexing, like John Bogle had said, the late John Bogle.
Even ETFs, you will not go wrong as long as you know what the ETF contains and you're investing in the long term.
Yeah.
Because let's say passively in India, you're sipping in the Nifty 50 ETF. It's good. You're safe if you're doing it for 10 years.
And there's also gold bees and other forms.
Those are ETFs. So we did digress and have a little bit of fun, but it's a valid and serious and legal instrument of trade.
Yes.
As long as you know what you're doing.
So that being said, we hope you enjoyed this video. Thank you for watching. Please hit the like button if you liked the video. Please subscribe if you haven't already. If you hit the bell icon, you'll get notified of when we upload our latest videos. And finally, if you have any comments or opinions you'd like to express, please leave them in the comment section below. We'd be happy to take a look. Thank you again for joining us on VRich.
Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.